Let's talk about some of the relevant risks in banking. Depending on the types of activities that a bank performs, there are multiple risks involved. For example, credit risk is inherent to lending, it cannot be eliminated. Or market risk is inherent to capital markets trading. But there are other categories of risk, such as operational risk, which are always there regardless of activity. There's a long list of risks, so let's take a look at some of the most important ones. Risk management is core to the banking industry. This is because risk is a necessary component of the business model. It cannot be avoided, period. Specifically, credit risk and interest rate risk due to lending. Because lending is a core operation of banks, these types of risks can never be eliminated, only mitigated. And how well they are mitigated is a key factor in banking efficiency. So banking risk is something that, in all of its forms, must be managed and mitigated, never eliminated. There are countless types of risk in a bank, but there are usually two main types that are considered, and these are credit risk and interest risk. Since they have to do with lending, which is usually where the major part of the income comes from, they are the ones that usually have the biggest financial impact. Credit risk is very simple. It has to do with borrowers defaulting on payments. That's it. It's the risk of extending credit. It's important to note that the yield of a portfolio of loans is affected by even one default, which subsequently affects the net interest income. For example, you have a portfolio of 50 loans, where the full portfolio pays 1 million in interest, but you just have a 5 million default with zero recovery of any value. So what happened is that you just wiped out the interest income of this full portfolio for 5 years, or 5 months. I didn't define the period. That's my fault. But you see the point. Loan selection is crucial in mitigating this risk. Just one default can compensate all of the profit that you're making on the other loans. Then we have interest risk, the second major type, and this is related to changes in the interest rates, whether the bank country's currency interest rates or other countries' interest rates, or the interbank offered rates for loans, which usually affect every single floating rate in any loan. So these are a problem, and they cause disturbances in the funding to deposit balance because what happens is that banks usually cannot entirely push the interest changes on their consumers. What I mean is the following. If the interbank offered rates go from 5 to 6%, even if all your loans as a bank are floating rate, in practice, you can't raise all of them 1%. Borrowers will simply not accept it. They'll just refinance and find another loan where they pay less, and they liquidate your loan. Or on the other hand, if the interest rates go from 4% to 2%, you can't just take all of your customer savings deposits of 4% and reduce them to 2%, maybe 3%, maybe 3.5%, because customers will never accept that. And then you also have the worst offenders, which are fixed rate deposits. Banks hate these, and for good reason. Let's say that a consumer has a 5% deposit. Even if interest rates go from 5% to 0, or even negative in an extreme case, that person is getting this 5%. So this is why interest risk can cause problems. In short, any change in interest rates, whether an interbank offered rate or a country's currency rate, will not be able to be reflected by the bank entirely. We will cover both credit and interest rate risk in their own lessons. But for now, besides these two, let's just enumerate some of the other relevant risks for banks. The first is operational risk, which lately has had a bigger and bigger focus on cyber risk. Operational risk in general is the risk that something will fail related to people, processes, or policy. Missing a payment to a customer, extending bad loans, selling the improper products, bad customer service, having a bad process to offer loans are all problems. But with the move to digital and mobile, cyber has become a bigger and bigger preoccupation. Data breaches, service failures, and so on. Then we have reputational risk, the bank's reputation being damaged. Since it's such a big part of product marketing, reputational risk is a tangible problem with dollar amounts associated with it. Another risk is liquidity risk. That's the risk of not being able to liquidate assets for cash. And when we talk about liquidity risk, it can be at the loan level or even at the bank level. For example, let's say that an individual consumer puts up as collateral a set of rare Pokemon cards. How are you going to sell these for repayment if they default? You need to have them valued. That has costs. Maybe you need to store them in a specific facility. So there is a liquidity risk with a specific collateral of loans. But there's also liquidity risk for the bank itself. For example, in the 2008 subprime crisis, banks had portfolios full of CDOs, collateralized debt obligations, and other structured finance products that were losing value quickly. So finding a buyer for these became harder and harder as other institutions started to dump them. That's liquidity risk. It's the risk that you can't liquidate assets fast enough or find buyers for them. Then we have funding risk. Very simple. It's the risk of losing depositors, or not necessarily the depositor, but a part of their deposits. It can be caused because you don't pay enough interest, or there are other alternatives, or many other possibilities. Then comes model or correlation risk. This is the risk of using the wrong models, for example, to evaluate loans or estimate provisions for losses, which in turn can result in liquidity problems. So this is, for example, not inputting a bad financial metric in your model. So your model is flawed and it can't analyze a loan proposal correctly. Correlation risk has to do with correlations of financial instruments. It's you holding 50 million in instruments that you think are all completely independent and then finding out that if one of them fails, all of the other ones go down as well. Since the models are usually part of a process, this can be considered a type of operational risk as well. Then we have legal and compliance risk. This is the risk of failing to comply with laws or regulations, which results in fines or sanctions. For example, there are strict measures against money laundering, detecting sudden changes in transaction volumes or values, storing data, requiring customer information, and so on. But some bank branches, just in order to make more money, will accept fake accounts with high volumes of money from crime rings or suspicious individuals. And when the authorities find out, naturally, they get fined. This is that type of risk. It can occur because employees are greedy, or possibly because the compliance department in the bank doesn't have enough power or enough information. Then we have underwriting risk. In specific, when the bank is underwriting debt securities and pricing them, or guaranteeing or insuring them. And this is the risk of not properly addressing the risk of that debt. So, for example, in private debt, we talk a lot about pricing for risk. If a loan is high risk, it's high reward. In other words, if there is a high probability of default, the interest rate is much higher. What happens with mezzanine debt, for example? If the loan is safer, then the interest rate is lower as well. But underwriting risk, for example, is the risk of underwriting a debt security that's high risk, but wrongly assuming that it's low risk and charging low interest rates, for example. In short, it's not being able to properly price for the risk that the bank is taking. Then we have business risks, and these are risks related to the actual business model of the bank. So, business model flaws, such as in the pricing of products, new competitors entering the space, or the bank's market share being eaten away by others. Then we have market and portfolio risk, and this is the risk present in securities. It's either the general market risk, known as undiversifiable because it's endemic to the market, but also the secondary risk of specific portfolios called a diversifiable risk because it can be mitigated with diversification, or even the idiosyncratic risk or unique risk of a unique security, which is also diversifiable. For example, let's say that the bank holds a portfolio of stocks. There is market risk in the whole portfolio because anything can happen to the market. Then, if there's a portfolio of IT stocks, for example, it's subject to diversifiable risks of the IT industry, semiconductor prices, material prices, and so on. And also, let's say that you hold Apple stock in specific within that portfolio, there's idiosyncratic or unique risks just because of Apple. It's the risk of Apple's competitors, internal supply chain, and more. So these three layers are always present. What are some examples of relevant risks? The first is the role of cyber in operations risk. This is a component of operations that's only increasing in importance. As technology advances, banks are more vulnerable to cyber attacks and data breaches. Hacking, man-in-the-middle attacks, spoofing, protocol cracking, and so many other variations. Then, model and correlation risk is one of the most interesting types because it's the risk of not properly estimating loans or assets or their correlation with other assets. It's a flaw in the algorithm that makes the quantitative analysis. It can lead to not pricing risk properly or just taking more risk than the bank should. Then we have complex underwriting operations. Underwriting occurs when the bank, for example, guarantees or insures debt instruments that may have a certain amount of leverage that may be much higher than expected, or when the price is too modest compared to the risk. One example are derivatives. In the past, banks sold derivatives without really understanding them, and the clients bought them without understanding them as well. So they had no idea of how much leverage was included in these instruments, and especially with structured finance products, which could be synthetic, so they would be made of other products. So you can have a 2 million mortgage that's being used as one of the bases for a 20 million CDO, which is used as one of the bases for a 200 million CDO. And although the mortgage is 2 million, the final CDO, that's synthetic, may be 200 million. So a small fluctuation in that 2 million mortgage can completely wipe out a 200 million CDO. And when you sell hundreds and hundreds of these that are based on common mortgages that are not diversified, one small value security can wipe out a whole market. And when you don't understand how complex the product is, you can severely misprice it. What are the key takeaways this time? The first is that credit and interest risk are the two major types of risk to banks. Mostly credit risk. This is because a heavy part of bank activity and these risks are endemic to lending. Borrowers not paying or interest rates changing, for example. Then, credit and interest risks are inherent to banking. Due to the high degree of lending activity in banks, these are a necessary evil that cannot be eliminated, just mitigated. And finally, besides these two types, there are many other risks that must be managed, from operational and cyber risk to modeling and correlation risk, underwriting risk, reputational risk, compliance risk. conduct risk, and many other types. So as we see, although credit risk and interest rate risk are the two most pervasive risks in the banking practice, there are a lot of other risks which are important to be aware of.